Hello everyone, welcome to yet another session of the daily news analysis by SRIRAM'S IAS, where we take up the important articles appearing in the Hindu newspaper and break them down from the perspective of the UPSC examination and look for ourselves as to what is the important information and points that we have to study from these articles. With this, let's dive right into the important articles of the day. The important articles which appear in the Delhi edition of the Hindu newspaper dated 9th June are on the screen. Let's take up the first article for the day. The first article which appears in the newspaper talks about the RBI raising rates to tame inflation. Now, it is a significant development that has happened where the Monetary Policy Committee, which is the apex decision-making body of the RBI, has met and has decided to raise the repo rates of the RBI, which will in a bid to tame inflation rates. Now, what is this news all about? What are all the terms that we keep hearing of, such as Monetary Policy Committee, repo rate, all of this? How will it control inflation? We'll talk about all this in the discussion to come. This particular topic becomes important for us from the perspective of prelims as well as main in the context of Indian economy, right? So this article becomes important because a lot of questions appear in the newspaper from the banking sector and the affairs of the RBI and the policy decisions taken by the RBI. For example, let's take a look at these questions which have appeared in the past year prelims newspaper. This question which appears in 2020 talks about the expansionist monetary policy of RBI. We'll be talking about this in our discussion as to what are the different policy stance that the RBI takes. So the question asks us about that. And in 2017, the question is asking about the Monetary Policy Committee, which is the decision-making body of the RBI. So with respect to these past year questions which have appeared in the newspaper, we get to understand the importance of this issue, and that is why we'll try to understand what has happened and the different terminologies related to this event. So now what has happened, that on the basis of an assessment of the current and evolving macroeconomic situation, basically the factors of rising inflation, the Monetary Policy Committee at its meeting decided to increase the policy repo rate under the Liquidity Adjustment Facility or LAF by 50 basis points to 4.90% with immediate effect. Consequently, the standing deposit facility rate stands adjusted to 4.65% and the marginal standing facility rate and the bank rate to 5.15%. Now, what are all these terminologies? What is repo rate? How does the changing of the repo rate impact standing deposit facility and the marginal standing facility? We'll understand all of it, and we'll also understand what is Monetary Policy Committee, what does it do. So first of all, we'll talk about the Monetary Policy Committee. What is this body that first of all is taking all these decisions? So the Monetary Policy Committee was constituted in 2016 as a statutory body under the RBI Act 1934 in order to formulate the monetary policy in India. So we know that whatever decisions the RBI takes with respect to the money matters in India is known as the monetary policy. And what is fiscal policy? Tell me in the comment box below what is fiscal policy, right? So this is the job of RBI to formulate the monetary policy, and the body which does that is the Monetary Policy Committee. Now, what is the mandate of this body apart from taking these decisions? So in terms of inflation, center fixes the inflation target every 5 years, which the MPC has to adhere to and to also to reach that target. So what is that target which center has set? The center has set a target of 4% plus minus 2%, which means that the inflation of the economy should stay between 2% to 6%. And currently, what is the inflation rate? It is going above 7, which we can see that it is exceeding the targets that was set for the Monetary Policy Committee, and that is why the time has come for the Monetary Policy Committee to take charge of this inflation and to control inflation. Hence the headline, to tame inflation, right? So now talking about the composition of the MPC, there are 6 members. 6 members means that 3 members come from the RBI and 3 members come from the government. Out of the 3 members of the RBI, one is the RBI governor, who's also the chairperson, the ex officio chairperson of the committee. The second member is the deputy governor, and one more member from the RBI to be nominated by the Central Board of Directors. So these are the 3 members from the RBI, and the other 3 members are to be appointed by the central government. A committee is set up for this appointment, which is headed by the cabinet secretary, and that committee nominates these 3 members which represent the central government. So in this manner, the decision making body for the monetary policy has a healthy balance from the RBI as well as from the government. So this is about the composition. Now what about the term of these members? They hold office for a period of 4 years and they are not eligible for reappointment. So once their appointment for 4 years, they hold their term, and after finishing their term, they are not eligible for reappointment. And the meetings, the MPC is required to meet at least 4 times in a year, and currently the MPC meets around 2 times in a month. So it holds regular meeting. Now this meeting what has happened, and in this meeting is what the decision has been taken. Now the decision, in terms of the decision, whatever decision MPC takes is binding on the RBI. And how does the decision is taken? It is taken on the voting procedure. Band ho gaya kya? Okay. The MPC takes decision based on majority vote by those who are present and voting, right? So we can see that there are 6 members. So what happens? So all these 6 members vote on the majority matters basis on their votes. Now what can happen when there is a tie in the voting process? In that scenario, the RBI governor acts as a chairman. In his capacity as a chairman, comes and casts the final vote. So that's how the governor will have the second or casting vote in terms of a tie, and the decision of the committee would be binding on the RBI. This is the decision making process for the monetary policy committee. Now with respect to this, can we solve the previous year question which appeared in the prelims paper in 2017? The question says that it decides, the MPC decides the RBI's benchmark interest rate. This is a correct statement. We saw that the MPC does that. Then it is a 12-member body, including the governor of RBI, and is constituted every year. This becomes a wrong statement because this is a 6-member body and it is reconstituted every 4 years. And it functions under the chairmanship of the Union Finance Minister. This is a wrong statement where the chairman is the RBI governor. So the correct statement becomes 1 only. Right? So in terms of the banking affairs, all of these things become quite important. All right. Then we understand the policies of the tools used by RBI to control inflation, or in short, the money supply in the economy. And how does the RBI do that? Are the names of these tools called as repo rate, reverse repo rate, marginal standing facility, standing deposit facility. These are nothing but the tools used by RBI to control the money supply in the economy and hence impact the increasing or lowering of the inflation in the economy. So let's understand how that happens. Now first let's start with understanding what is the repo rate. This repo rate which has been changed and increased by the RBI in this meeting. So the repo rate is nothing but that rate at which the RBI grants loans to the banks. It is the rate at which the RBI lends money to commercial banks in order to help these lenders meet their short-term liquidity needs. So whenever these banks need money for their needs, they can ask the RBI for money and the RBI lends them money. The rate at which RBI will lend them money is known as nothing but the repo rate. So whenever the RBI is lending money, what will the banks deposit in terms of the this money? They deposit the government securities as collateral. So this is how the transaction goes, where the RBI lends them money and the banks deposit the government securities as collateral. So some banks sell their securities to RBI to borrow money, followed by a repurchase agreement. So whenever the money would be taken back, they would be repurchasing those government securities. And the repurchase agreement states that the bank will repurchase the securities from RBI at a later date at a price decided in advance. This is the concept of repo rate. Now what are the different durations of repo rate? So the duration range from 1 day to 14 day to 28 days, and also new form of repo rate has also come up, which you must be seeing in news, what is known as LTRO or long-term repo operations, the duration of which go on from 1 year to 3 years. What does this mean? What is this duration? Simply the duration for which the banks are taking money. So the money can be taken for a day, or for 14 days, or for 28 days, or for the longer term such as 1 year to 3 years. This is the duration for taking loans from RBI. And what is the rate which we were talking in this? There are two types of rate. One is the fixed repo rate, which the news talks about, wherein the rate was fixed at 4.9%. 90%. This is the rate which is fixed by the RBI. So this is one type of rate, which is the fixed rate. The other rate is the variable repo rate. Now what is the variable repo rate? Variable repo rate is decided via auctions. Basically, when RBI has to lend money to banks, it holds an auction in which it asks the banks for what interest rate they are willing to give. And whichever banks can offer the higher interest rate, there the variable repo rate can be set up. So that is the concept of variable repo rate, where the RBI via auction process decides the repo rate between the banks which are bidding in that process for paying that much interest. And is there a maximum limit for which the banks can borrow from the RBI? There is, and it is up to 2% of the NDTL or net demand and time liabilities. What does this mean? So whatever time deposits and demand deposits are with the bank, the 2% of that amount the bank is eligible to take loan from the bank. So for example, let's say that the bank has NDTL or deposits, time and demand deposits for rupees 100. So the amount which the bank can borrow from RBI will be rupees 2. This is the 2% of their total net demand and time liabilities. This is the maximum limit which RBI has set for the banks to borrow. This is the concept of repo rate, wherein the banks borrow money from the RBI. I hope this is clear. Then what is the marginal standing facility rate? Now as we saw in the repo rate, it is a operation which is done for a longer duration, right? But there can be instances where the limit of the banks has been over, where they have already taken loan for the 2% of their liabilities and they want more loan and they want in a shorter span. That is where the tool of marginal standing facility rate comes up, where the MSF is a facility by which again the RBI grants loans to the banks but on a very short basis, on an overnight basis. So is the rate at which RBI lends funds overnight to scheduled banks against government securities. So this again becomes a difference, where the repo rate was for commercial banks, the marginal standing facility rate is for scheduled banks against government securities again. And RBI has introduced this borrowing scheme to regulate short-term asset liability mismatch in a more effective manner. So what I was saying, that it might happen that they have breached the limit of 2% and they are in dire need of money, the banks can approach RBI against the tool of marginal standing facility rate to ask for loan. Now naturally, if they are asking for an overnight loan, the rate of interest in this particular facility can be high than repo rate. It is indeed like that, where MSF interest rate is always 25 basis points above repo rate. So now, if today the monetary policy has set the rate of interest for repo rate as 4.90, what would be the MSF rate now? It would be 25 basis points above, which would be 5.15%. This would become the MSF rate. That is how changing the RBI only decides the repo rate, and the other rates become automatically aligned with it and they change. How they will change, we'll look at that. For the first marginal facility rate, we understood how it is set 25 basis points above the repo rate, and this is where the MSF stands today. Now, duration, as we saw, it is an overnight facility, so duration is 1 day and the rate is fixed at 25 basis points higher than repo, and there is a maximum limit for the MSF facility as well, where up to 3% of the net demand and time liabilities of the banks, they can borrow loan from the RBI. These are the two instruments using which the banks borrow loan from the RBI. I hope this is clear. So what can be the differences between these two? First of all, both repo rate and MSF are rates at which RBI lends money to various other banks, so that becomes the similarity. But the difference is that the repo rate is applied to loans given to banks that are looking to meet their short-term financial needs, while the MSF is meant for lending overnight to the banks. So the duration becomes the differentiating factor, and the repo rate is the rate at which money is lent by RBI to commercial banks. This we saw, while MSF is a rate at which RBI lends money to scheduled banks. This is the difference, another difference that we saw. And lending at repo rate involves selling of bank securities as collateral to RBI along with the repurchase agreement, and the loans given at MSF rates involve providing government securities as collateral. So the providing of government securities as collateral is similar, but the difference occurs in MSF, the banks can also provide those government securities which are a part of SLR. SLR, which we also call statutory liquidity ratio. Can students tell me in the comment box what is statutory liquidity ratio? So there are some government securities which are set aside by the bank as a part of SLR or statutory liquidity ratio. So while taking money from RBI from the repo rate, they cannot put government securities which are a part of SLR as a part of collateral for while taking loans under repo rate. But this is not a case of MSF, where under MSF they can deposit government securities as collateral which are a part of SLR as well. So that also becomes a major differentiating factor between the repo rate and marginal standing facility. I hope these two tools are now clear. We'll move on to the other two tools. Now, if there is a mechanism by which, before the two tools, let's understand a few things about these two tools. Now, if there is a mechanism by which RBI takes money from the banks, so what will happen? Can there be any impact via these rates, and how is the increasing repo rate being linked to taming the inflation? When RBI is taking money from the banks, where it is granting loan to the banks via this repo rate, what will happen? More money will flow to the banks. If more money will flow to the banks would be able to grant more loans to consumers or in the market, and what will then happen? Increase in money supply will happen. So if the RBI decreases the repo rate, it would increase the money supply of the economy, and purchasing power of the consumers will increase. Consequently, if the repo rate is increased by RBI, what will happen then? Then the banks would be discouraged to buy loans, and in that way much less money will go into the economy, and by controlling the supply of money flow in the economy, the RBI would be able to impact the inflation, where it would be able to decrease inflation in the economy. I hope this is clear. The impact of increasing and decreasing repo rate is the connection point which we need to make, which is what the RBI has done in the monetary policy report, where it has increased the repo rate, due to which the money supply in the economy would be controlled and inflation would be controlled, and brought from the 7% range into the target range of under 6%. Right? Now, what are the other two tools? The other two tools which to apply reverse are the reverse repo and standing deposit facility. Now, what are these tools? If there is a tool by which RBI grants loans to the banks, but there can be other tools as well, where the banks park their surplus funds to the banks, wherein the banks deposit their money with RBI and RBI grants them a certain interest on it. This rate is known as the reverse repo rate, and the two tools which are done for that purpose is the reverse repo rate and standing deposit facility, which is the new tool introduced by RBI. Now, what is the difference between these two? The reverse repo rate, as we saw, is the rate at which banks deposit their money with RBI. So, if the banks deposit their money with RBI and the RBI grants interest to the banks on this, what will happen? The money would be coming out from the economy and getting parked with RBI. With this, would the money supply be able to be curtailed? So, the RBI uses reverse repo for sucking out excess liquidity in the economy, as well as the standing deposit facility also does so. We'll understand about standing deposit facility, but these two instruments work in the same manner as far as their major mandate is concerned, where both these instruments are those instruments using which the banks park their surplus funds with RBI and take interest on it. Now, with reverse repo, obviously if the banks are parking their surplus funds, RBI needs to provide the government securities as collateral to suck out money from the banks. So, let's say that the bank is depositing money with RBI, the RBI in turn gives the banks government security as collateral. So, let's say that if government has to take out 100 crores rupees worth of rupees from the economy, and it asks the bank to park that much funds with RBI. So, consequently, government securities worth rupees 100 crores RBI needs to have to add as collateral with the banks. So, that becomes the criteria with reverse repo rate. And what is the maturity period for reverse repo rate? It can either be called overnight or the duration can be 14 days. And what is the relationship with repo? Again, that we saw that RBI fixes only repo rate and other rates gets fixed automatically. So, the repo rate becomes 105 basis points below the repo rate. This is how the reverse repo rate also gets shaped. And is it provided under the RBI Act? Yes. Both instruments of repo rate as well as repo rate are provided under the RBI Act. And is there a limit? So, there is a minimum limit which the bank RBI can accept as funds is 5 crore, and the maximum limit is that there is no limit for maximum money that can be deposited. Now, what is the standing deposit facility over here? This is the new kind of instrument added very recently, which was notified, the guidelines of which were notified very recently in April 2022, wherein, like we saw in this example, if the RBI wants to suck out liquidity from the market, but it needs to have government securities worth that money to keep as collateral with the banks. And it might so happen that the RBI would not always have government securities worth that much money. So, a new instrument was introduced known as the standing deposit facility, where while using this instrument, where the banks would be parking funds under RBI, the RBI would not need to add the government securities as collateral. Since the duration would be overnight only, the need for adding government securities worth that much money was taken away. So the RBI need not provide any government securities as collateral to suck out money. So that becomes a major difference point between reverse repo and standing deposit facility. And the duration of this is overnight only. So marginal standing facility and standing deposit facility, they're similar in terms of the duration, where both are for overnight only. And what is the rate which is fixed for standing deposit facility? It is always 25 basis points below repo. So now if 4.90 was the repo, 25 basis points below repo would mean that the standing deposit facility rate is 4.65%. This becomes the rate for standing deposit facility, and it is provided under the RBI Act, and the minimum value that banks can accept is 1 crore with no maximum limit, right? So I hope these tools are clear. If there is any doubt, you can post the doubts in the comment box. Via this news which came out in the newspaper, with the increase of repo rate, the RBI is trying to decrease the inflation in the economy. We tried to understand what are the different aspects of the Monetary Policy Committee and what are these tools which are used by the RBI to carry out these functions. These are concepts which are thoroughly need to be understood and always are asked, or the questions based on these concepts are always featuring on the newspaper, in the question paper. With this, let's move on to our next article for the day. The next article which appears in the newspaper again is a very important concept which talks about ahead of sowing, Kharif MSP is revealed. So the article talks about the minimum support price, which becomes important for us from the point of view of GS3 or Indian economy for both prelims or mains. So in the news article, it talks about that the government has unveiled increased MSP for 14 crops ahead of the Kharif season. Kharif season starts from the monsoon, right? With the monsoon, the sowing of the Kharif season starts. So before this Kharif season is starting, the government has released the rates of MSP for 14 crops, wherein it has increased the rates from 4 to 7%. So on this backdrop, let's try to understand certain basic points about MSP as to what is MSP, how is it calculated, who calculates it, who puts it out in the open. Let's understand all of these questions. So what is MSP? So MSP, or minimum support price, is the rate at which the government buys grains from farmers. Why does the government feel the need to buy grains from farmers? Because a lot of times, due to the market constraints, the farmers are not able to get the right price for their grains, and a lot of times they have to pay lesser price for they receive lesser price for their grains, and this is where the government stepped up and guarantees them that we will be buying your grains at a certain price. That price which they say is the minimum support price. So currently it fixes MSP for 22 crops grown in both Kharif and Rabi season. So currently in India, for 22 crops that are grown in Indian agriculture are a part of the MSP regime. How is this calculated? So MSP, obviously whatever the farmer is growing, how much ever is the cost that he is inculcating to grow that much crop, the MSP is set of at least 1.5 times the cost of that production incurred by the farmers. So therefore, it is the rate at which government purchases crops from farmers and is based on a calculation of at least 1.5 times of the cost of production that is incurred by the farmers, so that the farmers at least get some kind of profit to again start with the next cycle of sowing. The union budget of 2018-19 had announced that MSP would be kept at levels of the 1.5 cost of production. Now, who calculates this MSP? So, the body known as the Commission for Agricultural Costs and Prices, or shortly called CACP, calculates this MSP and recommends the MSP for these 22 food crops to a body known as Cabinet Committee on Economic Affairs, which then releases the MSP. So there is the important catch in this concept which we should understand, that there is a body known as the CACP which calculates and recommends MSP. So the job of CACP is to calculate the MSP and to recommend the MSP, which is a statutory body, right? And then it submits that recommendation to the Cabinet Committee on Economic Affairs, which then releases the MSP. So if asked which is the body that calculates and recommends the MSP, that would be Commission on Agricultural Costs and Prices, or CACP. Which is the body which releases the MSP, which in today's article has featured, where the MSP hike has been released, that has been done by the Cabinet Committee on Economic Affairs, right? So I hope this concept is clear. Then let's talk about the calculation method of MSPs. Which production costs are taken in fixing the MSPs? Now, if we think logically in this as well, whatever the farmer incurs in terms of the process of producing this crop should be the calculation method used for calculating MSP. This is what goes into the calculation, where there is a term called A2 and also a term called A2 plus FL and a third term called C2. We don't have to get confused by the complicated terms. It is actually very logical. Let's understand. So what is A2? A2 costs cover all paid out expenses both in cash and in kind incurred by farmers. So the farmers, while growing the crop, whatever all paid out expenses he or she incurs on seeds, fertilizers, chemicals, hired labor, fuel and irrigation, among others. So for all these expenses, the expenses are covered and clubbed under A2. They are known as A2, right? And then what is A2 plus FL? A2 plus FL covers the actual paid out costs, whatever was above, plus one more component is added, the imputed value of unpaid family labor, right? So the family labor, which is also an important part of growing the crop, is also included in this A2 plus FL component. And then what is C2? The C2 or costs account for the rentals and interest foregone on owned land and fixed capital assets respectively. So the rentals and interests foregone on owned land and fixed capital assets respectively are the component of C2. Now all of this is clubbed together, and the CACP considers both A2 plus FL and C2 costs while recommending the MSP. So all of these components are taken together to calculate the cost of MSP, right? So this was information relevant from the prelims point of view with respect to MSP. A detailed discussion of the merits and demerits of MSP will take soon in another discussion. With this, let's move on to the next article for the day. The next article which appears in the newspaper talks about the India and Vietnam relation, where they have signed a mutual logistics agreement. Now, the importance of India and Vietnam relations can be seen from this year's prelims newspaper, where a special question was asked in this year's prelims. Let's take a look at the question first. This was the question which appeared in the June 5 prelims this year, where Vietnam was solely in focus and of the question, where 5 statements were asked about Vietnam, about it being one of the fastest growing economy in recent years, it being led by a multi-party political system, its economic growth linked to its integration with global supply chain and focus on experts, and Vietnam's low labor costs and stable exchange rate have attracted global manufacturers. And Vietnam has the most productive e-service sector in the Indo-Pacific region. So we can see the focus attached to some countries in the prelims question paper. One need not worry about such random questions appearing in the question paper. A lot of difficult questions appear, and the selection is not based on these kind of questions, but the more predictable questions from the content matter which we keep regularly studying. Nonetheless, since this question has appeared, it tells us to look in the direction where the UPSC is looking, and it talks about the East nations or Southeast nations which are there, which the India is engaging with increasingly, and the importance they hold in the current strategy for India of combating China, as well as strengthening its hold in the Indo-Pacific region. In that manner, Vietnam becomes very important, and that is why the question features. With this, let's try to take a look at the India-Vietnam relations as to what is the importance of this this relationship, what are the different components. Now we know that India and Vietnam share a similar historical past, where both nations fought for their independence from the colonial invaders, right? So in that they hold similarities. With that, both of them have a tiff with China, where even Vietnam has fought wars with China, and currently in the South China Sea dispute, it has a dispute with respect to certain islands with China. So a lot of strategic points converge for India and Vietnam, and their strategy for Indo-Pacific, as I was saying, that the Indo-Pacific strategy for India, Vietnam plays a big role in it. That is why the India-Vietnam partnership has been a strong point since a lot of years, and they are also now strengthening it, which the news article talks about, that the defense ministers of both countries have signed a logistics agreement. Now, what is a logistics agreement? We'll see that, but this is a point where they have taken the defense ties on a deeper level. So let's look at certain important points on the India-Vietnam relation, where from a meager US $200 million trade in the 2000, the bilateral trade between India and Vietnam has seen a steady growth over the years, and it has reached to around 11.2 billion. According to Indian statistics, in the financial year April 2020 and March 2021, bilateral trade between India and Vietnam reached to US dollars 11.12 billion. So from $200 million to $11.12 billion. That's a significant increase in the bilateral trade between the two nations. Where, how much is the share? With India exports to Vietnam amounting to $4.99 billion and Indian imports from Vietnam at US $6.12 billion, right? So the imports from Vietnam are more than the exports to Vietnam by India. And for the financial year 2021, for India, Vietnam was the 15th largest trading partner globally and the 4th largest within the ASEAN, following Singapore, Indonesia and Malaysia. So for India, Vietnam was the 15th largest trading partner, and for Vietnam consequently, on the other hand, India was the 10th largest trading partner globally. So both these nations have a quite converging relationship in terms of trade, where they are quite, they have bilateral partnerships on development, making connectivity plans, all of these issues. But the significant point of their coming together is on the defense front, where the defense cooperation is of quite importance, where a lot of defense trade is happening, and whatever technology India is developing in terms of the defense sector, it is supplying or it is planning to supply Vietnam. So while Vietnam is interested in modernizing its armed forces, India is interested in developing defense capabilities of its Southeast Asian partners sufficiently to maintain peace in the strategic region, right? So this is a big converging point, because supplying defense equipments to the Southeast nations is of utmost interest to India to strengthen its hold in the Indo-Pacific region, as well as in a bid to counter China. So Vietnam is interested in India's Akash surface-to-air systems and through advanced light helicopters and BrahMos missile. So supplying these equipments to Vietnam, the talks are going on. And apart from this, the defense relation include capacity building, dealing with common security concerns, training of the personnel and cooperation in defense and R&D. On these lines, today's article suggests that a new logistics agreement has been signed between the two nations. What is a logistics agreement? When two nations come together to form a military cooperation, a lot of times certain logistic and administrative help is also required from time to time. such as refueling or fuel facilities or certain logistical facilities. So when, let's say, whenever an Indian aircraft is flying from the airbase of Vietnam, Vietnam will now support or give logistical support to India, and this is the crux of logistical agreement, where both countries provide each other with that logistical support. India has also signed such kind of a logistics agreement with US very recently, right, which is shortly called the LEMOA. So this is a similar logistics agreement which has been signed with Vietnam. And also additionally, as the article says, $500 million defense line of credit is also being supplied to Vietnam. So this was the important points which we had to see from the perspective of India-Vietnam relations, right? So that's the end of today's discussion. We'll meet tomorrow again with the important articles of the newspaper. Thank you.